you look at technology, basically anything that the government doesn't touch that has technology involved experiences deflation, prices go down. Magically, anything that the government touches, prices go up and there's inflation.
This podcast is for informational purposes only and does not constitute financial, legal, or investment advice. Please consult a professional advisor before making decisions based on what you hear on this show. Welcome to that Wall Street Tribe. Get ready for a blast from a past 2022. Your friend, Chris Larsen of Next Level Income. Chris, so glad to have you back, man.
Always good to see you guys. And I'm always, if anybody watches any of the podcasts, it looks like I'm crying because I was laughing so hard before we get started. And I'm glad we got some of the joking around out. I don't want to get anybody in trouble here today.
Yeah, well, we're going to turn from jokes to serious because right now, as we record this, April the 9th, 2025, there's a lot of fear and trepidation in the marketplace. And you've been around and seen a lot of cycles. And I kind of want to lean in and kind of better understand what uncertainty you believe's out there. Is there strategies that are winning? I want to lean into your personal stuff because you've invested in a lot of different areas. I want to understand better what's working, what's not. And that way the person who's listening to us can maybe make not perfect decisions from our information, but at least have informed feedback. So as you see all the recent volatility as it relates to tariffs and other areas in the headlines, what do you think's happening? Do you feel like there's opportunity out there? Where can we lean into and gain insight?
Yeah. So, well, thank you all for having me on it as well. I think there's a couple things I want to mention. We talked about, you brought up cycles here, and I want to talk about the real estate cycle and kind of where we are in my mind in the real estate cycle. But to address the tariff question and where we are from a macroeconomic perspective, I think I don't, regardless of where the stock market was, I don't think the U.S. economy was on a sustainable trajectory. And I think that I've said this repeatedly over the past several weeks. I think the U.S. economy was kind of like a drug addict, and we're in this phase right now where we're basically weaning the economy off the drugs of cheap monetary stimulus that had been used. If you look at just the job data, if you question me and say, "Well, I don't think that's true, Chris," if you look at the job data, all the jobs that were created in the past 4 to 5 years went to foreign-born workers. Whatever you think of immigration. So we were losing jobs. Americans were losing jobs. And if you look at the number of jobs that were created by the government, there was actually an even more meaningful loss of jobs. And it takes about, do you guys know how many private sector jobs it takes conservatively to cover one government job? You guys have how many taxpayers?
How many taxpayers it takes to pay for one government job?
Yeah.
No.
On average, on the low side, it takes 80 private sector workers to cover one public sector worker. So, you look at all those government jobs that were created, we weren't on a sustainable track. We would have to raise taxes 50% to cover the budget deficits, or we'd have to slash spending, not 75% or more in some cases, just massive numbers.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we were able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stallion, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before. Go to what'swhatwallstreet.com/PIOS.
And I've been listening to, Howard Lutnick.
Yeah, Lutnick. Yep.
Yeah. And he's talking about kind of his goal was to slash 1/4 of the government workforce and to save $1 trillion, right? Like, out of our $4 trillion, annual budget, if you will, or lack of budget spending, the goal was to shed some of that. So I didn't even consider if it takes, and ultimately 80 people to cover that one job, what the real impacts of that is.
Yeah, it's massive. And I just heard this. I was listening to to an interview last week and heard that. And I was like, wow, you think about the multiplier, the leverage on that it has for that number of employees. But then you think about, well, okay, let's say you take a talented, skilled government employee and put them in the private sector they're now being productive, right? And I don't think anybody with a straight face would argue that the government is efficient. So I think, slashing 25% is reasonable. I've been in companies where we've had downsizing and done things, but you look at technology, basically anything that the government doesn't touch that has technology involved experiences deflation, prices go down. Magically, anything that the government touches, prices go up and there's inflation. So, there's a lot of different sides to this argument, but my point is we are on an unsustainable track, and I can argue all day long on why that is. And I think the ultimate end, if you listen to Scott Bessent, was essentially we were coming to the end of the US dollar as a reserve currency around the world because of we were on that unsustainable track. So basically we have this choice where, the US economy was a drug addict, and we either say, hey, we're going to wean the economy off these drugs and get back on a sustainable track so we're healthy and we can survive, or we're just going to keep doing what we're doing and hit a brick wall, which was going to have dire implications, much more dire implications than seeing the stock market drop 10 or 20%, in my opinion.
Well, that's a great take on like what the current situation is. Talk now about what are the implications of that weaning process, and what people should kind of expect if they play out the way that you think they will.
Yeah, so I think I don't think President Trump or Scott Bessent or Howard Lutnick, anybody's been shy about saying this. Like, there's going to be some short-term pain, to get this long-term gain. Which it's like anything. It's like last time you and I worked out together, Russ. Like it's you gotta push yourself, to strengthen things. So I think I don't know exactly what's going to happen, Joey, but I think, we're going to see pullbacks in the stock market. I think a lot of what's happening right now in the stock market, specifically, we're talking about April 9th, is due to a lot of deleveraging that's occurring. So you have hedge funds that are out there that are leveraged 20-1. And if they continue with the strategy that they were employing, given what's going on with the cuts and the tariffs, they face the risk of blowing up. So think about if you're leveraged 20-1 and you lose 5%, you're done. Okay. So if you see that train coming down the tracks, you start to pull leverage off the table. To give you an idea for anybody that's followed the stock market finance history, we remember long-term capital management back in the 90s blew up, created massive issues with the stock market, and had to be bailed out with the government. The numbers today are greater than those leverage numbers. So these are things that, as what we're seeing, with the bonds being whipsawed up and down, some of that is happening because there's certain firms out there, individuals, groups that are out there they need liquidity. So they're selling their bonds, which is driving bond yields up, bond prices down to generate this liquidity because they don't want to sell and lock in their losses. So a lot of the stuff we're seeing is a reaction to what's occurring, so people don't get run over by that train. So I think we're going to see a lot of short-term volatility. Things are going to shake out. I think that the tariff situation is going to ultimately put the U.S. in a better, stronger position, specifically in relation to China, and strengthen some relationships around the world. I think a lot of making the private sector healthier, making the government more efficient, unleashing cheaper energy into this country. All these things are going to be really good long term for the economy.
As you listen to this, there are a couple of so what's to what's going on. One, the government's trying to or has to refinance, I think it is $6 trillion in debt over the next 9 months, which is why we're seeing them push ultimately treasury yields way down. So those who have been investing in treasury bonds, they're going to see the new ones coming on the deck not as profitable as they were before. What that will mean to us as we are getting long-term debt, we'll see long-term debt rates cheaper, right? So I want to talk about that in a second with you, because I know there's a lot of investments you guys have made where you go and get bank financing. So that will be good for all new deals, right? And we'll even make hopefully opportunities for refinancing possible that hasn't been out there. But also we know that it's going to potentially push. We're going to see pressures push up on short term rates, right? As unless we can see how the tariffs don't impact cost of goods, right? We're going to see where the short term may be heavy. So if it's all right, I'd love to kind of lean in personally to your own stuff. Talk a little bit about what your portfolio looks like right now. And then I want to, maybe have you share kind of what are you most bullish on given this rate environment and what's happening.
Yeah. So again, I don't have a crystal ball, but I think that is part of the intent of the administration right now is to push bond rates down so that we can refinance our debt at a more favorable rate. That would be good for commercial real estate. I think part of the pull on the other side of that is the dollar potentially weakens in this scenario. You have potentially less international investment. So, that's something to consider when it comes to investments that are out there. But one of the challenges we've seen, Russ, to specifically address your question, in the last 6 months, if you look at multifamily, which has been the center of our portfolio, both on the apartment side as well as the mobile home park side, deals just don't work because rates shot up. It's hard to make a deal pencil with from a cash flow perspective, and then it's also hard to sell deals to create liquidity to buy new deals because valuations have been suppressed, or the ability, and part of that is like, if we're not going to buy a deal because rates are high and the price is too high, why would somebody else buy one of our deals? So, a lot of the deals that are out there, if they have cap rates in the 4 to 5% range, a 0.5, a 50 basis point move, a 0.5% move can affect the value, 10 or more percent of these assets. So that goes both directions. So it's a big deal. So one of the challenges we're seeing, in the multifamily market over the past 2 years, we've seen record supply come on the market. So that means new apartments are coming on the market. Demand has been very strong still, but we've had a lot of supply on the market. And why is that? It's because if you go back a couple of years ago, money was essentially free. So you had rents rising double digits and you had rates at record lows, couple 2-3%. So, it was very, very cheap to build these products. Now, if you're a developer and you're putting that new apartment on the market, you have to sell it. Like you have a loan to pay off. It's built, you have to sell it. So what do you have to do to sell it? You have to get it leased up to 50-75% to sell it. What are you going to do to lease it up? The answer is anything necessary. So if you have an apartment complex in a great city like Nashville, and you have a brand new apartment on one corner and another one on the other corner that's given away 3 months free, what are you going to do to keep your residents? You're going to either have flat or potentially even slightly downward rent growth, which is what we've seen over the past 2 years. So that means that income hasn't increased. Now, the good news is supply is dropping off a cliff. Again, why is that? Prices have gone up, interest rates have gone up, cost of building has gone up. So all of these things have increased. So I think what we're going to see over the next 2 years is a reversal in that trend. And then if we see a reversal in rates, if rates drop again, that's going to be another tailwind for multifamily.
So what are you most bullish on? Like right now, like if you, I know you're saying, hey, over the next 2 years, we're going to see that change, but what's the thing right now that you're saying, hey, here's an opportunity?
Yeah, I think right now, if you look at interest rates, so, I've talked about the 18 and a half year real estate cycle in the past. When interest rates are high, banks are profitable. Be the bank lending money. So right now, lending is very strong. We have a debt fund, private credit. So coming in to provide liquidity for those owners that say, hey, I don't want to sell my property right now. I want to push it out. If you can get double-digit returns lending money, versus say, if you can get 10% lending money versus say 13, 14, 15% in equity investment, that's a pretty narrow spread right now. So I'm bullish that, lending will be strong for the next couple of years. I do think that mobile home parks, affordable housing is going to continue to be a very strong market, Russ. I think that, again, rents are still high. It costs more than it ever has to buy a house right now. So what are you going to do? You're probably going to rent longer. So, anything that's affordable housing, I think is going to do well. Again, lending, affordable housing, and then, we were talking about this before we hopped on today. I actually think that we're facing a crisis in senior housing as well. And I think over the next 10 years, that's going to be very strong. And then industrial, as we continue to grow e-commerce, I think all those areas are going to be strong areas.
Thanks for that, Chris. I want to back up 1 second on the person that's listening to you right now who is in a multifamily that has stopped paying distributions because of all the factors you just mentioned. Are they give them some hope as to what the next 2 years look like in that particular project? And I know you're not speaking to their specific one, but in general, hey, this is going to reverse, that trend's going to reverse. Yeah. What does that actually mean for the person who's stuck in it, what would consider a dead deal right now?
Yeah. So there are going to be some shakeouts. If you're in a deal and that debt matures and you can't refinance it and there's no capital to continue to hold that deal, either the owner has to renegotiate with that bank. There's going to be some losses. There's going to be some opportunities out there for that. That's why I mentioned private credit. If you can come in and you can provide some of that liquidity to maintain that deal, that can be a really attractive opportunity for investors that want to get in that layer. If you're in that deal, I think the most challenging deals are going to be those lower BC assets that the rent growth just isn't going to be there, and the cap rates aren't going to compress like they were. We saw some really crazy cap rates in C quality product, over the past three or so years. I think the higher quality deals are going to outperform because as the supply drops off, people that can't buy a home, they're still going to rent. And we're going to see that rent growth resume again. And as cap rates, in my opinion, creep back down, maybe they don't drop back down the 3s or 4s, but as they creep back down 50 or 100 basis points, I think we're going to see the valuations go up, and the ability for banks to come in and lend on those is going to go back up as well.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz. Hey, Wealth Without Wall Street family. If you're serious about building passive income through real estate, then you need to check out Dustin Heiner's podcast, Master Passive Income.
Yeah, Dustin retired himself at 37 years old using rental properties. And now he's teaching you how to do the very same thing step by step. If you're looking for real estate strategies that actually work, this is the podcast for you.
So go subscribe to Master Passive Income wherever you listen to podcasts and start building your path to financial freedom today. Go check it out now. Some hope at the end of the tunnel there, as long as the deal survives, is that, if I sum that up?
Yeah, I think, those high quality deals, those class A assets in markets that are still growing, that have rent growth, I think that, ultimately they're still going to be around. The question is, is the debt going to be able to be restructured or refinanced in a timely fashion to maintain, that cash flow and that valuation?
Cool. Okay, so in the past, you've actually spoken in our live events about car washes. I'm curious where you stand right now in this environment under the car wash kind of model, and have you made any adjustments to your investing strategy there?
Yeah, excellent question. And car washes are more business related. Going into Q4, actually my top performing investment was one of my car washes in Q4. And in our overall portfolio, we have 32 total car washes in our portfolio, has had some record months over the past 6 months. And that's fairly exceptional because the industry as a whole has been flooded with a lot of private equity capital over the last 3 to 5 years. So we've seen some newer operators come into the market that just aren't performing. So we actually have not bought anything. We closed on our last deal in January of last year, 2024, but we haven't put anything under contract in 18 months. So we've kind of let some of these deals shake out. And part of the reason is, again, interest rates are higher. It's hard to make these deals pencil out. But car washes are great recession resilient in businesses. They're kind of like affordable luxuries, and high performing car washes in good markets can be really good cash cows for that. So I think that those that segment can be a great performer. Kind of these little boring businesses like laundromats, car washes. There's a lot of other businesses out there. I think will continue to perform. Things that people do or use every week can do really well. So we're certainly looking at some deals again for the first time in 18 months, and the numbers are going to start to work out again as we get some good deals on assets that people are going to have to let go.
Well, I want our audience to learn from your wisdom as an investor. So talk about that. As you're starting to evaluate deals now, how are you stress testing deals before saying yes, given the market climate that we're in?
Yeah, I think the biggest risk that's out there. So any investment. So I lost money in a fund over COVID, and we had it was like if 30% of the businesses failed, we were still going to make money. And COVID, it was a small business lending fund. They like all stopped paying. I was like, who would have thought that? So I will take the caveat and say we're still applying a lot of the same standards, but the things that we don't see, like interest rates going up 5% in 6 months, COVID happening, Helene hitting Asheville, North Carolina, and me having to pay my mortgages and my taxes and insurance when my tenants didn't have any legal obligation to pay me. That was really painful. So, from a stress testing perspective, I think one of the things that's important, especially if you're going into a volatile economic climate, is you want to be more conservative with your lending, with your leverage, and you want to have more capital, more liquidity in these to weather some of these storms. When it comes to, the investment opportunities that are out there, I mentioned, lending, private credit, I would rank liquidity higher on the list than normal. So, can I get my money back if the economy starts to take a downturn? Like, can I say, hey, I'd like my money back and pull it out? Or am I in front of someone else that is owed money on a property? So if I'm lending money, am I in like a similar position as the bank, or am I the bank on a property? So even if a property loses, say, 20% of its value, can I still get my money back? I think it's less about the stress testing, and it's more about what is the margin of safety that's in there. And I think right now is an important time to have a higher margin of safety.
That's great advice. In light of another piece of advice, I think, and we can't speak to this because we're Wealth Without Wall Street, Chris. So we had to bring somebody else on and put on our earmuffs for just a second. But if someone is listening right now and they still have money in the stock market, God forbid, what would you say? Like, how would you coach them necessarily on reallocating those dollars and shifting gears?
Well, hopefully they've been listening to you guys. And I would say I'm like Wealth mostly without Wall Street. So I'm not anti Wall Street. I'm like, I'm like, I love dessert, but I have it like once a week, right? And I think if you take one, you divide by 7, so 7 days in the week, you get what, like 15? What's the number? What's 17%? I don't even know. I should be better. 15, 17%, something like that. That's probably a good amount to put in the stock market. If you look at billionaires, centimillionaires, you're talking about typically less than 20%. So if you're looking at your portfolio allocation, I would consider, if you got 60, 80, 90% in the stock market, you got a lot of risk. And I think the challenge with a lot of investors, they look at the past couple of years, and I heard this last year, people would say, oh, I'm getting 20, 30% in the stock market. Why would I invest in real estate? You invest in real estate, so when the stock market goes down, your portfolio is still resilient to do that. So I would say, you need to get to an overall portfolio allocation that makes sense and probably is more like the way, the ultra wealthy invest. So, 20 to 30% in real estate, 20 to 30% in fixed income. I love cash value real estate for fixed income. You look at the alternative space, some Bitcoin, some gold, some of that stuff. And then, you have fixed income is another big one. I'm not sure if I said that or not, but probably about a quarter in fixed income. And then, reallocate over a period of time into that. But you don't want to sell everything right now and then be stuck, with a huge loss. You probably want to do that over a period of time and get more towards an allocation that is more resilient.
And I think that's the hard part, right? Like there's people right now that are paralyzed. They don't know what to do.
Yeah.
And
Yep.
they say, there, I think if you haven't seen this chart, it's a great chart that talks about the emotional swings of investing in the market. And we haven't had an up and down market really over the last 15 years. Like as a
Yeah.
country, we used to go through this cycle about every 4 to 5 years. So people got
Mm-hmm.
very resilient, as you said, to it.
Mm-hmm.
But now we've kind of forgotten that cycle. But
Yep.
there's this beautiful emotional roller coaster that happens. And as we see this early dip, we see this first 10 to 15% sell off in a traditional correction that goes 20 or 30% deep. We see in the first, 15% usually people are saying, oh, people are stupid. This is the rats jumping off the ship. Let me buy because this is where the money's going to be made.
Yep.
And as it keeps dropping, that, optimism starts to turn to pessimism. And when they get at the very bottom, that's when they completely jump out.
Yep.
And they say,
Yep.
this is stupid. I'm never doing this again. And then as it starts to rebound, they start talking about how everybody's going to lose their shirt. It's going to keep going down. And then as it keeps going up, then they start getting FOMO and say, I've got to get back in. And that's why most people end up selling at the lows and buying at the highs. And you can look at what the history of the market is, but it doesn't apply because human behavior says that they end up doing the wrong thing at the wrong time. So I don't know, like to your point, we don't know, are we at the front end of a 30% correction and we've dropped 15% and there's another 15% to come? Was 15% all there was? And is it going to rebound? And obviously,
we'll probably know by the time this airs. So, but
we might.
No, I mean, and to your point, Russ, the average investor performance, I was just looking at this chart last weekend, or last 20 years, the average investor made 3.5% in the stock market. So what you just laid out is the reason for that. So I guess what I would say is pick your portfolio allocation and adjust it to that over, say, 2 to 5 years. Don't say, okay, I'm Chris, I'm going to cut my portfolio allocation in the stock market all the way down to 15% from 85% and sell everything right now. That's not a good choice either. So I would say, do your research, figure out what the right portfolio allocation is for you. Again, I like to follow what the ultra wealthy do. Groups like Tiger 21 talk about these. You guys are no stranger to the fact that I'm a humongous fan of cash value life insurance. That can be very comforting when you're in these times where you need liquidity for certain things, and then adjust over a period of time, rebalance over a period of time, so you're not locking in these huge losses and then potentially buying into another area when it's at the market high for that other sector.
As we start to wrap up, I don't want to miss the opportunity to ask you've been in our passive income mastermind since the very beginning. You're one of the founding members there. And there's people that have been on the fence, have been considering joining a group like ours. They've set up their passive income operating system. They got infinite banking in place. They've done a number of deals. So they're not a new investor. And yet they kind of have been this do-it-yourself person, and they're trying to decide, why should I be in a mastermind? What is the real benefit? So for you, have been a part of this group for, I guess, almost 4 years now, what has it done for you? How does it help you with, in environments like this and other areas? Would you speak into that a little bit?
Yeah, I think to be successful, you need a few things. There's information, there's strategy, but you also need accountability. You need people around you that can help coach you when things don't work. I mean, if you take your typical financial advisor, what is the value they provide for that 1% that they charge? It's that they tell you, don't sell when the market's down, like stick to your plan. So, I know you guys might not like that example, but I use that for a reason, because even in that scenario that we were just talking about, people that have a coach that have somebody that helps them stick to their plan are going to outperform those that don't, that deal with their emotions. It's the same reason why you go to the gym and you have a personal trainer. It's the same reason I work with a concierge medical service that says, hey, this is how you should eat. These are the supplements you should take. This is how you can kind of course correct throughout. I can probably figure it out on my own, but it's probably going to take me, say, 5 or 10 times as long. If it takes you 5 or 10 times as long to figure it out, you might be wanting to retire and be out of time when it figures that out. So the big thing about the passive income mastermind is you get the structure, you get the information, but you get the connections with people, you get access to the deals, and you get access to the knowledge to help you assess the deals and also give you comfort. I know there's deals that we've all been in that haven't worked out. I gave the example of that private business lending fund. The one thing I found is when the more people you talk to that have a lot of money, they all have deals that haven't worked out. You know, it's like being in a relationship. If anybody said, "Oh, you're going to meet the person of your dreams," I know, Joe, you're unique to this situation, but I'm going to have one person I ever meet in my life. I'm not going to have any failed relationships. You'd say, well, that's kind of crazy. Like, of course you meet people and things aren't going to work out and you're going to learn. Why not have a team around you and a group, a mastermind around you that can help speed that process up so you don't have to go through all the pain?
That's so awesome. And man, we're so grateful to have you in the group. You add so much value. I think that's the other part of a mastermind is it is the collection. You're not just there to receive, you're there to also provide and give value. So man, thank you for being willing to come back on the show today. And
thanks for having me.
We'll navigate, man. These are some choppy waters right now, and we need some information, but we also need some insights to help us navigate it. So appreciate you. For people that want to connect with you, what's the best place for them to go?
Yeah, check us out at nextlevelincome.com. You guys have been on my podcast before, both together as well as separately. Although maybe only you, Joey, because I don't trust Russ all by himself. He needs a chaperone to come on the podcast.
For sure.
I'm messing around. But you get a free copy of our book there at nextlevelincome.com. You can check out our podcast there. If you want to learn about some of the investment opportunities that we have out there, including our debt fund that I mentioned earlier, you can also click on the invest link and schedule a call with our team.
Yeah.
Awesome.
We appreciate you, brother. Thank you for sharing and especially leading in such a volatile environment.
Thank you, sir. Thank you both for having me on, and keep your chin up out there, guys. It's a rough environment, but that's what we're here for, is to support each other. And you guys are doing a great service for everybody out there that listens.
All right, tribe. If you found value, take time to share this with someone else. Maybe even share it on your social so we know we need to create more content just like this. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.